Welcome to The Explainer. You know, we've all seen those movies about stock market schemes, right? Well, what happens when a real-life racket worth billions threatens to bring down an entire country's financial system? Today, we're pulling back the curtain on a massive scandal in Nepal that did exactly that, shaking the very foundations of its share market.
And this quote, wow, it really gets to the heart of it. This wasn't some simple mistake or just a bad day for the market. No. What investigators uncovered was a calculated, high-stakes operation run by powerful elites, and it left a trail of financial devastation that shattered the trust of everyday investors.
And here it is, the number at the center of the storm, 3.8 billion rupees. That's the value of illegal trades that were made on credit, basically with money the scammers didn't even have. It's an absolutely staggering figure that put the entire market and thousands of regular people at immense risk. So it really begs the question, how on earth could a scam this big even happen?
Okay, so every crime has a crime scene. And for this one, we need to step inside the Nepal Stock Exchange, also known as NEPSE. And as you're about to see, it's a market that, for years, seems to have been playing by its own very strange, very enigmatic set of rules.
So check out this contrast. During the pandemic, as global economies were just going into a freefall, Nepal's stock market was somehow booming. It was charging ahead like nothing was wrong. This defied all economic logic. For anyone watching the market, this wasn't just weird. It was a massive red flag that something was artificially propping it all up.
So what made it so vulnerable? Well, the answer lies in this kind of technical term, weak form inefficiency. But all that really means is that the market is slow to react. It has a memory. Think of it like a card game, where you're allowed to see the last few hands that were played. For skilled manipulators, this memory is an absolute goldmine, letting them predict and even control where prices are going to go next.
This quote from the Himalayan Times just puts it perfectly. In a market like this one, doing your homework, studying a company's real value, it just didn't matter. The diligent investors, the ones who played by the rules, were actually the ones who lost out, while the people who knew how to rig the game got rich.
So with this vulnerable market basically as their personal playground, how exactly did these criminals pull it all off? Well, investigators uncovered a surprisingly simple yet absolutely devastating playbook of manipulation tactics.
One of the key weapons in their arsenal was something called circular trading. It's deceptively simple. Imagine a small group of people in a room, and they're just selling the same baseball card back and forth to each other for higher and higher prices. From the outside, it looks like that card is incredibly popular and valuable, right? Well, that's exactly what they did with stocks, creating a fake buzz that lured unsuspecting investors right into their trap.
And all of this, of course, leads to the classic pump and dump scheme. Step 1, you accumulate a ton of shares on the cheap. Step 2, you use tricks like circular trading to pump that price to the moon. And then, the final brutal step, you dump all your shares onto hopeful investors who bought into the hype, leaving them with worthless stock as the price just crashes back down to earth.
So, how can you spot this kind of thing? Well, analysts point to some pretty clear red flags. Is a stock's price soaring, but almost all the buying is coming from just one or two brokers? Is it hitting its maximum price day after day, but there's no good news to explain it? Those aren't signs of a healthy company. They're warning signs of a trap.
All right, so we've got the crime scene and we've got the playbook. But who were the masterminds behind all this? A detailed report from Nepal's regulator, a body called SEBON, finally started putting names and faces to the whole scheme.
So, investigators found that one particular brokerage, Prakriti Stockbroking, was the linchpin. They allegedly allowed these massive trades to happen on credit. That means the manipulators could buy billions in shares without putting up any of their own money. This is not only totally illegal, it's incredibly dangerous because it creates this phantom demand and puts the whole system at risk if they can't pay up. And this table here breaks down the key players named in the report. Right at the top, you have Deepak Bhatta, who's accused of being the mastermind. He alone allegedly owes the brokerage nearly 2.9 billion rupees. Then you've got Raj Bahadur Shah and Shubhi Agrawal, both accused of manipulation with hundreds of millions in outstanding dues. Look, these are not small-time players. This was an organized, high-level operation. But here's the thing. This wasn't just about a few rogue traders. The real shock from this investigation was how it exposed a deep, systemic failure. The problem wasn't just the players in the game. It was the referees, the very institutions that are supposed to keep the market fair for everyone.
And this is not the first crack in the foundation. Just look at this pattern. Back in 2021, the heads of both the regulator and the stock exchange were investigated for insider trading. And today, even the current leadership at the regulatory body is reportedly under investigation. It just raises a critical question. When the watchdogs themselves need watching, who can investors possibly trust?
Which brings us to the final, crucial question. It's pretty clear that just punishing a few bad actors won't be enough to fix a system this broken. What's needed is a complete top-to-bottom reform of the institutions that are supposed to protect investors. But until that happens, how can anyone investing their life savings in this market ever truly feel safe again?